Good afternoon, good evening, good morning. Bonjour, bienvenue and welcome to our webinar today. We will just give it a few more moments while people are joining. The technology, as we know, is not completely instant just yet. We have about 50 or 60 participants signed up for today, so we're just waiting for everyone to join the room and give it a few moments. Good afternoon, good evening, good morning. Welcome to our webinar today. We're just waiting for everyone to join the room. Bonjour, good afternoon, good evening. Welcome to our webinar on estimating credit losses with MassRestructurings, a roadmap and case study. Today's event is sponsored by Triple Jump Advisory Services and delivered to you by Inspiring Development. We are a management services provider and MSME banking consultant. My name is Carmen Geil, and I am your moderator for today. Today's event will be delivered in English and is also available in French language. For French, please select the French channel in the interpretation menu in the bottom of your screen. If you're on a mobile or on an iPad, you may have to select the menu with the 3 dots more, and then you find the interpretation menu there, and you may choose the French channel. I will just introduce that to our French participants as well. Bienvenue à notre webinaire. Estimation de perte de crédit en combinaison avec les restructurations massives, feuille de route et cas d'étude. La langue originale étant l'anglais aujourd'hui, vous avez une traduction simultanée disponible sur un deuxième canal dans le menu en bas de votre écran qui s'appelle Interprétation. Sélectionnez le menu en bas de votre écran et il se peut que ce soit 3 petits points More. Ensuite, vous avez l'option Interprétation et vous pouvez choisir le canal français. La présentation PowerPoint restera en anglais. La vidéo sera compartie en anglais et en français. Merci et je vous souhaite un bon webinaire. Thank you. Our webinar today will last about 1 hour and 45 minutes in total. The first 1 hour and 15 minutes roundabout are presentations by our wonderful presenters. The following 30 minutes, are dedicated entirely to your questions. You are able to ask questions by using the Q&A tab, the Q&A option also in the bottom of your screen. You can ask questions already throughout the presentations as they arrive and any time. You have the ability to ask questions anonymously or indicating also your name. We will do our very best during the Q&A session at the end to get to all your questions and to answer them to the best of our knowledge. We are also recording today's webinar and we'll be sharing that recording with you within 48 hours through the same Zoom link where you have received the invitation from. We will also include the PowerPoint for you to download. One request is if you had to leave throughout the presentation or a little bit early, please make sure you fill in the survey for us. There's a little pop-up that comes up and asks you to fill in a quick survey for us. There is not a lot of question there. It just takes a few minutes, but it is very important that we know what you are interested in so we can design the next topics according to what is of interest to you. As always, we are curious to know who is here with us today. We think it's quite interesting for you. You probably think it's interesting as well. And we use Menti as usual. So could we ask you to participate in the surveys and in the polls by going to menti.com from either your computer, your mobile, your laptop, anywhere really, and enter the code 47858771 as you see it here on the screen. The page is menti.com and the code is 47858771. When you get there, you'll already see the first question, and that's our curiosity. We like to know a little bit, where are you calling from today? Which country are you calling from? Just simply type it in, and then it'll appear here on the screen for testing. So welcome already to our participants from Myanmar, from England, and everyone else who is still going to menti.com. Welcome also to Singapore. And you can see here on the screen that all our participants are joining from a variety of countries. So we give it a moment. What we'd like to reassure you, Menti is anonymous. We have no way of knowing what you're saying, who is saying what. The information simply doesn't get kept or tracked for who does what. You're all anonymously participating in the meeting today through the meeting room number. And here already, thank you very much for joining and welcome to Cambodia, Moldova, Indonesia as well, Zambia, Kosovo, India, Jordan. Welcome to our webinar today. And because we all know practice makes us masters, we have a second question for you to just know a little more. What institutions do you represent? Is it a microfinance institution? Is your institution a deposit-taking microfinance institution? Is it a full-fledged bank? Or it is a different kind of institution, such as an international investor, shareholder, or anything else, as others suggests. Lovely. Thank you very much for your participation. And there is most definitely there are no banks here with us today, actually, microfinance institutions only. Thank you very much. Deposit taking and non-deposit taking. Thank you very much for your participation. And please keep this page open. Throughout the presentations, our presenters will also come back to this Menti poll, and we'll have some interesting questions to find out what is the situation in other institutions on these topics around ECLs, mass restructurings, and the topics around it. So now we are getting to the point where we are sure it is high time for you, where you want to know what we are going to be talking about the content and the presenters. So let's do that. As usual, we start with the practical aspects and an introduction, followed by the bit of what have we seen in the past, the large-scale use of restructurings that we've been seeing. With the COVID loan restructuring waves, the practical implications that that has had for institutions like yours, what we have seen, my colleagues have seen in cases that we've been directly working with and analyzing, establishing a systematic approach to loan restructuring. How do we do that systematically? Something that didn't used to be part of our daily practice, certainly, and establishing assessment of portfolio quality in that adjusted approach and expected credit losses in the era of COVID. How do we need to look at it from this perspective with these mass restructurings that most of us have? And then we have a practical example for you where we approached portfolio assessment from this perspective, what you can do and what is possible to give you a meaningful estimation of credit losses. Apologies. Followed, of course, by some key takeaways and then the Q&A session. And this will be presented today by my two lovely colleagues. Sorry, wrong sheet here. 1 second. First of Vanessa Inacio, apologies for this, principal banker with Inspiring Development, has many years of experience in credit risk management in MSME banks. And she's also our topic expert and team lead on portfolio data analysis and IFRS 9 modeling. Adyan Salihu is senior banker with Inspiring Development and a finance and risk professional with executive management experience in MSME banks. He is our team lead in institutional analysis, finance and financial risk with a very strategic perspective in these topics. Please, throughout the presentation, don't forget to ask your questions, and I leave you in the very capable hand of here Adyan and then Vanessa as well.
Thank you, Carmen. Good morning, good afternoon, everybody. My name is Adyan Salihu, and as Carmen mentioned, myself and Vanessa will be the hosts for this webinar today, and will be guiding you throughout the content of this session today. Thank you very much for joining, and we are really looking forward to sharing our experiences that we've had in those topics with you today. Carmen, if I may get control of the screen, thank you very much. Yeah. Thanks. So before we actually dive deeper into the topic, I wanted very briefly to just use a couple of minutes to discuss a bit more what we are planning to achieve today and which are the main topics that we will be addressing throughout. And obviously, there are three main elements that we will try to bring across. One is about loan restructuring, as mentioned by Carmen, whereby we will go a bit deeper and explain what is happening now and what implication this is having. We've seen a lot of use of loan restructuring during COVID, in various forms and various means, including relief measures that have been granted by many institutions. And then related to that, we will be diving a bit deeper in discussing what implications that has in the portfolio assessment of those institutions, and furthermore, how to make a reasonable assessment of that portfolio and the risks that are related to that portfolio. So this will be basically the content that we want to deliver. Both myself and Vanessa will be taking different parts in it and will be guiding you through. However, before we dive deeper into it, I thought it would be useful that we just go a little bit on the context, just that everybody is somewhat on the same page on what's happening and how we have got to this point where we are today. I mean, as you all know, in the past, restructuring, especially in microfinance institutions, was very rarely used. It was often kind of considered as a taboo in the institutions, and it was very selectively applied. So often in larger customers, we saw earlier that we don't really have banks in this webinar today. Banks used to do it more often, and specifically related to larger clients, SME or corporate clients. That was somewhat traditional, but typically not really applied on micro customers. Whenever it was applied in micro customers, that were occasions, it would have typically been applied as a really last resort of recovery, which was then obviously not leading to much results out of it and just contributing further to this negative view that restructurings are bad or ineffective and should not really be in the using the tool set of the institutions. I think what also contributed quite a lot to this is the approach by the regulators that often considered restructurings as bad portfolio and pushed institutions in building more and more provisions related to any restructuring that they would build. And quite often these provisions actually were quite significant as compared to the standard portfolio, which obviously was contributing that institutions rarely used then restructurings as tools. Lenders also, on the other hand, often have considered those loans as bad portfolio, associated with them with NPLs and so forth, which were also often connected with covenants that they had in the loan agreement. And all of these factors have contributed in the past that there is really no widespread use of restructuring. And we used to see this every time with our work, with different missions and projects that we were having. And always we were trying to advocate that there is a bit more use of restructurings as a way of dealing with good customers, not only with bad customers as it was applied, but also with customers that need a bit of breathing space, that need a bit of time to adjust to certain changes in the environment, changes in the business and so forth. But then not much was happening until COVID came, and obviously that would be then the next point, or just elaborating a bit what it meant with COVID in terms of implication. Majority of the institutions were underprepared on dealing with restructuring. So there was no proper framework in place where loan restructuring was a tool in the tool set, where there was a defined methodology, defined criteria, policies and processes in place and so forth that would enable institutions to handle it. And quite often, actually, even the system itself, the core banking system, the IT solutions were not there, whereby institutions were unable to identify those customers, flag them, and be able to monitor them adequately. So obviously that was the past. COVID came and everybody had to do restructurings, as otherwise portfolio at risk was reaching levels of about 50%. So at that point, it wasn't really optional, and everybody started doing all kinds of restructurings, often driven by regulators or being pushed by them, so to say, but often also institutions themselves took on initiative and started to do more and more of these restructurings, and very often also mass restructurings on really large scale, often without even clients even knowing that they have been restructured and so forth. So all of this is what we see currently on the ground with different missions and different projects. As you can see on the charts that I've provided here, these are from real cases that we've had just recently. but you can note a very high increase on the degree of restructurings as compared to the past that we used to have 2-3%. Now suddenly we have levels of 70, 50, 90% of the portfolio and so forth that are restructured, which means that basically every institution is doing it, but often it's difficult to know what is behind these portfolios because all clients have been put in this box, and it's somewhat of a mystery actually what is in this box and what implication that has and what is the quality of this customer. So if everyone is being put on the restructuring pot, so to say, it becomes difficult to assess and understand what is behind that portfolio, which are the clients that are performing, which are the clients that are not performing, and so forth. And that raises complications. It raises complications on one hand with the institutions themselves. What we see often in the ground is that there is a bit of a Wild West situation with those institutions, whereby the management is leading the institution a little bit blindfolded without knowing how deep the problem is with that restructured portfolio, without knowing which are the good clients, which are the bad clients. And that comes basically from what I mentioned before, not having had a framework in place, often the system itself not enabling institutions to know which are the restructured portfolios that or clients that are good, which ones are not, and so forth. Just leads to basically managing a bit like with a hit and miss or shooting in the dark, if you will, and expecting to get the results with a wait and see attitude after the COVID phasing out, and then to see which clients are starting to pay and which clients are starting to pay, which means that often that treatment that clients would need and that support that they would need under these circumstances would not be there. The second aspect that is related to that and has implication is obviously regulators and auditors. We are seeing this often with our engagements that last year there was a bit of a laissez-faire that everybody kind of left it on the open and turned a bit of a blind eye on the treatment and dealing with restructuring. So institutions were not pushed to consider those as losses, so to say. So it was a bit more at the decision of the institution how they would treat them. So there wasn't all too much pushback coming, neither from the regulators nor from the auditors, but they are nervous, and we realize that sooner or later they are going to come, and they will be stronger in expecting a better overview of what's happening in this portfolio. And likely the end of this year, it's not going to be like the end of last year, whereby calculations would be not as thoroughly checked. So we expect this pressure to keep on increasing. And that's why we thought that this exercise and this webinar will be useful for you, as it has been very useful for us and for a lot of sponsors that we've been working recently in different projects on how to have a different approach to this and how to have a better assessment of portfolio, so to say. And that obviously includes also investors who often are a bit on a standstill. So the entire investment universe is somewhat in a standstill, given that there are situations that without knowing in depth the quality of the portfolio, there will not be much movement towards taking decisions in granting loans to the institutions. There has been a raised hand. If there is anything that we would want or we would need to address, please post a comment or post a question in the Q&A session. We will address it as soon as possible. Thank you. And just before going a bit deeper then into the approach that we advocate, wanted to mention what would be the way forward that we consider and what we advocate moving on. Basically, there are two things that we consider. One is the short term and the other one is the long term. Long term, we consider that there is no way but institution to fix the restructuring. And with fixing it, I mean to have a proper process in place, to have a framework that would define what criteria, how to classify customers, how to categorize them into different levels, into different categories, and relate that to the risk that are associated with each category, and build a history that will be useful then in the future also to predict the losses from each and every category that you have in restructuring. We will be speaking a little bit about this later. But in the short run, we realize that that is not possible. A lot of institutions will not be able in a matter of days or months to fix all of that, as it requires time, requires investments and efforts. So we wanted to bring across a couple of additional analytical dimensions that can be used in this period of mass restructuring, whereby you're still not at the point that you can assess every client individually. So how to use some of these items or dimensions in portfolio analysis to be able to identify and cluster customers into the ones that are performing from the ones that are not performing and so forth. I would pass in a minute to my colleague Vanessa to guide us a little bit more through the content. But before we do that, I would kindly ask you to go to Menti. There are a few more questions that we would like to ask. And it is very useful for everybody who is in this session to understand a bit more what kind of situations other participants in this group are facing, and just that we have a bit of an overview from different environments how the situation is. So the first question is obviously related to restructuring. So would like to know how much of your portfolio has been restructured. And when I mean restructured, it includes also all the COVID-related measures that have been granted, like relief measures, extensions, waivers of interest and so forth, just to get a bit of an idea like how deep of a problem that is. So once again, not referring to really only restructurings that you might have had it as in the past, but any kind of relief measure that you have granted to your customer, any kind of extension of maturity that would also constitute as a loan restructuring. So just to get an idea. So as we are getting results, and obviously we see that there are institutions with participation quite high that have had restructurings above 25%, above 50%, and even the ones that are above 50%. The next question, if you help me, Carmen, would be related to the expected credit models. If you have one in place, and if you had to make changes or adjustments related to COVID. There are three questions: yes, no, and the third one is we don't have a credit loss model. So we see answers coming. Obviously, what we see on the ground from different engagements that we have is that majority of our customers had to change and had to make adjustment to their IFRS model. And even that was already proven to be challenging in dealing with some of the auditors and regulators and so forth. And that would be exactly the third question. Thank you very much for all your answers. That would be the last question on this time round, on whether you've had basically any difficulties dealing with auditors at the end of last year in accepting the results that you had from, be it IFRS 9 model or any other provision and calculation model that you might have had. And again, what we see on the ground is basically that majority of our customers have had those challenges, somewhere with less pressure, somewhere with large pressure, but we foresee coming forward in the next year would be very much that there will be an increased pressure. And that's why the earlier we fix this restructuring and are able to have a proper way of assessing customers in place, the easier we'll get. Vanessa, back to you with the rest of the sections.
Thank you, Arjun. Good morning, good afternoon, good evening. I'm Vanessa. And as you recall in the previous webinar, in the last quarter of 2020, we had discussed on how to calculate expected losses under IFRS 9. So we assume that most of you are aware at least on how to calculate them, and we'll keep on discussing about IFRS 9 as an example, as most institutions have applied that are very of IFRS 9. I think it's easier if we use this as a concept. So in this situation, what was happening before with the expected credit losses models, especially the IFRS 9 ones, was that most institutions were applying the following typical criteria. Mostly days in arrears, and due to imposition very often from auditors and regulators, very strict criteria regarding restructured loans. So in our case, we have seen most of the institutions we have been seeing in the ground have been using for stage 1, so low risk, everything that is in arrears from 0 to 30 days. Very often, as long as a loan is restructured, it's classified risk of stage 2. And of course, days in arrears is the backstop according to IFRS. And then we have the loans that are defaulted or impaired, of course, that are more than 90 days in arrears, but also the ones that have been restructured more than once, or for which there has been legal proceedings initiated, bankruptcy. IFRS 9 also suggests several other qualities. Very often, this is the typical criteria that has been used because it's easy to track and show evidence on. The other thing most that have already implemented IFRS 9 models know is that for life, so as long as there's good evidence of good repayment, loans can migrate from stage 3 to stage 1, which is also what we see in reality. So there are customers from temporary problems and then become again. What does this mean in terms of composition of portfolio is that we would have a situation where pre-COVID, most of the portfolio would, and we would have some situations where we would have some clients with facing some problems but still repaying, and then the ones that had already defaulted. This was easy to manage in terms of organizational structure because business could handle a couple of cases that were facing some temporary problems, and then we could have some more problematic cases being managed by recovery and legal. Of course, the low risk portfolio would always be with business. However, then we have COVID and the mass restructuring and COVID relief measures. So what happens if we don't do any changes to the criteria? Well, if we don't do any changes to the criteria, we would end up with a composition where we have most of our portfolio in stage 2 or in stage 3, so medium and high risk, according to IFRS. This would pose problems operationally because business would then have far more medium risk, more problematic clients to manage and a lower amount of time to deal with the healthy portfolio. But it's not only operationally that this has some impact, but also for loan loss provisions. So in terms of loan loss provisions, as we have here, the first situation, if before COVID, we would have a situation where most of the portfolio would be in stage 1. For those that do apply this type of models, know that for the lower risk portfolio, normally PD is very low, and it starts increasing with the higher the risk. And most of the portfolio is in stage 1. Naturally, the ECLs would have been low in this case, in this example, 3.5%. If we have then COVID with no changes to the criteria that we were applying before to assign the portfolio to low, medium, or high risk, or stage 1, 2, and 3, what would happen is most of the portfolio would have migrated to medium and high risks, to stage 2 and 3. And in these cases, as I already mentioned, PD is higher. So if PD is higher, the ECLs automatically would be higher, in this case 29%. This is one of the reasons why the IFRS board and many of the regulators recommended that the institutions did not apply mechanically pre-COVID criteria to do staging or assign risk status to the portfolio. Sorry. However, this doesn't mean we should apply to all COVID restructured and rescheduled loans, especially the mass restructured, low risk profile. As we all know, many sectors have been affected by COVID. So, for example, all of us know that tourism has been highly affected, especially the tourism that was very strongly dependent on foreign traveling. Restaurants, we know that in all of our economies there has been lockdowns. Some periods the restaurants have been closed. When they have been reopening, in many economies, regulators and government have imposed that the occupancy rate is 25%, 50%. So this naturally will impact their cash flows. And regarding manufacturing and trade, we have a mix. So some have adjusted quite easily to COVID. Some have had disruption in supply chains, and things like essential goods have done very well, but more luxury products, for example, clothing or been affected by COVID. So we have a mix, which means that our restructured portfolio cannot be classified all as low risk, but rather should be some part high risk, some part medium, and some high. So how can we go on classifying the portfolio as restructured low, medium, or high risk? Well, our proposal is to look a little bit to the concepts of IFRS 9 staging, because this already provides us some guidance. So in stage 1, we have the healthy portfolio. So the portfolio that has no signs of impairment, that's not defaulted, the client has no legal proceedings initiated, is not in bankruptcy. And we have also the situation when we don't see any type of higher risk that the not be able to repay the loan. In stage 2, the medium risk, there we already have situations where clients are, either for temporary reasons or maybe for a little bit more long-term reasons, are facing difficulties to repay as they used to repay before. So this one has a higher risk of becoming default in the future, and to this one we should assign then the stage 2. And then we have the ones that are already in significant trouble to repay the loan, that they have defaulted in some cases, have already legal proceedings of bankruptcy restarted. And these are the cases where the bank or the institution is normally expecting some losses. Maybe we even have to forgo some principal or interest. So this one is what we are proposing that should be the guiding framework for grouping COVID mass restructured loans. How can we do this? Well, ideally, as Ardine already mentioned, we should do individual assessments of the restructured portfolio. Of course, as it's a lot, we should prioritize bigger exposures and sectors that have been most affected. By doing this, we can find the best solution, not only in general for clients that have been affected by COVID, but as Ardine already mentioned, we should stop looking at restructuring as a lost recovery measure, but rather as one measure that we should apply earlier, and to find what is the best solution with the borrowers. Many borrowers face situations where they have no control of what has impacted their business. In these cases, we should try to work with the borrowers as our partners, because in the end, they were not able to control the situation. We as the institution are also not able to control the situation. So the best is to try to find a solution where we adjust the repayment schedules to the current repayment capacity of the client. And if everything goes well, this client might become a healthy client again, and we can continue a long-term relationship with them. With this information, we should then be able to classify each client by their risk profile. So we should know a medium risk of default, or if the client is already in a situation that he will likely or is already defaulting. This means we should also then adjust our processes and procedures because especially for situations that they could not control, should not be punished in the future for future lending due to this restructuring case. We should also ideally reassess periodically these clients, say every 6-12 months, to see if their repayment capacity has changed, and hopefully it has improved so the client can repay sooner to become in a healthy state faster, or maybe we have to then classify it as a higher risk. I know many of you are thinking what to do with the COVID mass restructuring, because the number of loans is very high, so you cannot do this type of individual assessment in the short term. But before we go to this point, because we will go to there, as Arjun already mentioned, Arjun will give us a framework on how to classify the portfolio that is restructured by risk profile.
Thank you, Vanessa. Yeah, basically, before actually I jump into that content, I would kindly just remind you that there is a Q&A button at the bottom of the page. So feel free to post any question that they come along as we are doing the presentation. And then at the end of the session, we will be addressing all of those. We have about 30 minutes of Q&A. Just feel free to post them at any time as they come along. Now, going back to the restructuring, what we try to outline now is basically how we would consider restructuring to be organized more as a conceptual guide, more as a general frame, but not necessarily addressing that in this webinar the operational aspects on how to operationalize restructuring as a tool. We are currently working on a white paper, which we will issue very soon. And once it is there, we will also circulate to all of you. That will provide a bit more guidance how to operationally from the business side organize restructurings and so forth. But in this session, basically what we want to outline is like conceptually how restructuring should be organized, and then how to connect that with the loss models that you have in place. Vanessa, if you help me with the screen, please. Thank you. So basically, we have three minimum items that we would consider for restructuring, or three main categories. Obviously, institutions can decide to have more as they see fit in their own context. But in our view, this is the bare minimum that all of us should have in our portfolios and be able to understand better what's behind these customers. We've named them low, medium, and high risk, so not very creative naming, but that was with the intention really to make them more practical. You can decide then later what kind of specific naming you would grant them. As standard restructuring, for example, could be an option for the low risk, because that has a lot of similarities with the standard performing portfolio and so forth. But this was just rather as a conceptual guide on what categories of restructuring should be there. So the first one, the low risk. What we have in this category are basically the customers that are new performing customers, the customers that are good, that have been paying well in the past, that you expect them to continue paying well into the future, with whom you expect to continue maintaining a relationship, hopefully lasting for years to come and so forth. So these would really be the customers that are prime, so to say, in your portfolio, but might have a constraint of liquidity, a short nature constraint limitation, and would need some breathing space. So with this kind of customers, you would obviously grant them a facility that would enable and that would give them breathing space, but would not necessarily automatically consider this as an increased risk and increased provisions related to this portfolio, or have a different treatment with these customers as compared to the ones that you have in your standard portfolio. Typically, the ones that would deal with these portfolios are the business people, so the department that is in charge. Obviously, it's useful to have a proper flagging in place so you can still monitor this portfolio, how it performs after it has been restructured. But by and large, the lead with these customers should be under the responsibility of business. The second category is the medium risk, which is a bit more complicated. So these are typically the customers that do have trouble, and these constraints may not be temporary, so often may be of longer nature. And the success of this restructuring would very much depend on the ability of the customers to be able to reorganize its business, to be able to reformat the way they are conducting their business, and to basically get back on his feet and be able to then repay the loans. But there is an increased risk with this category, and thereby a specialized team would have to deal with this group of customers, typically being the area management team or the recovery team, who know better and who are more specialized on how to deal with customers of this nature, and are able to also give them more adequate workout measures, so to say, to help the client in reaching to the point that is expected. We would would consider these loans, as I mentioned, with a higher degree of risk, typically as underperforming loans, and that's why the monitoring has to be more active in place and to see how these loans are performing. And then comes the third category, which obviously are the ones that are troubled or the most hit customers. And these would really be the customers where you would use this restructuring, so the high risk or heavy restructuring, as the last mean or last resort of recovery. In this case, you would basically expect a high degree of failure or a high default level even after restructuring, but at least you give it a try. And often the recovery from these loans depends on factors that are beyond the recovery from the business itself. So I don't know, sale of collateral, for example, or sale of the assets that the company has under control, or the micro customer selling own personal items to be able to repay some of the loans, guarantors stepping in and so forth. So it also includes recovery aspects beyond what the business can generate on its own means in those cases. Yeah, and obviously for this category, we do consider as a significant increase in risk, credit risk. But as you see, if you have the low, medium, and risk, you already have 3 categories, and you can get a better view within this restructured portfolio, which are the customers that might or are paying well and might be paying well also in the future, which are the ones that you have a bit more reservation, and which are the ones that are basically severely hit, with whom you might also eventually even include forbearance of interest or principal, or forgiveness of part of the penalties or in full and so forth, as a means of at least recovering the outstanding principal that you have out there with these customers. To bring it into a metaphor or an analogy of those cases, basically the low risk you would see as if I take a car, for example, a low risk would be a car that would need to go to mechanic for a flat tire or some little problem that would be fixed in a couple of hours, couple of days, but you would still expect the car to keep on running and be with you for the coming years. And the second category would be one where you basically would perhaps have a bigger issue with your car, leading to larger change that you would have to do, be it in the engine or really fundamental parts of it being replaced, which might work and might not also work, very much depending on the treatment that the mechanic would give to the car. And the last one, the high risk, would really be one of those circumstances where the car would be in a massive crash, and chance of the car recovering would or being back on the road would be rather slim. You would hope, you would take it to the mechanic, you would give it a try, but eventually you might still sell it for parts to be able to generate some cash. So just to use this as an analogy, and once you are able to portion clients into low, medium, and high risk, you are able to also connect them with the loss estimates that you have for each stage. So low risk being in stage 1, you would be able to connect that with the loss estimates of stage 1 and so forth. So this would give them a much better picture on the portfolio, and you would be able to also have adequate provisioning in place with those customers. Before we move further, I would like to ask you once again to go to Mendy. This is the last question that we have for today. It's basically related to the system that you have in place, whether there is sufficient flagging in there that you're able to control and monitor these portfolios. So if you please go again to menti.com 47858771, and the question will be coming up there, please. Vanessa, back to you.
Yeah, thank you. So yes, this is one of the things that, as Arjen has mentioned, many of us are struggling with. So it is an opportunity for us to share what type of flags we have in our institutions, or maybe we are struggling to implement them in our core banking system. Good, so we already have some answers. Most of you are already have flags implemented to flag loans that have been restructured or rescheduled. Also a COVID-19 flag, also, flagging the number of times you have restructured or rescheduled a loan, and you have also different categories of restructuring. Very often this is defined by the regulators, so standard, substandard, loss are very common ones. Good, thank you. I think most of you have already answered. So this brings us to one of the problems that we have, which is to deal with mass restructured loans. This problem has dealing with mass restructuring loans has posed several challenges. As we already seen in the Menti, many of us have had some difficulty to adjust the banking and core banking system. So we saw that most of you have already flagged for restructured or refinanced and rescheduled loans, but some of you are struggling, for example, to flag it whether it was due to COVID or not. So there were a lower number of people answering to that one. And this is one of the biggest challenges that we've also seen in the field, that many institutions are struggling to adjust their core banking systems because sometimes the software development takes too long. That's not possible because the structure is too strict. The other problem that we have seen in many institutions is the quantity of COVID loans. So it's a very high number of COVID loans. As Arjun already mentioned, it's very difficult then to do assessment of all of these loans one by one in the short term. The other problem that many of us are facing is that if it's not possible to do this type of flagging in the system in automatized way, then we have to rely on manual flags. Sometimes these manual flags are being done in the core banking system. Sometimes they are kept in spreadsheets. And then we have a problem that is associated with human beings. We all make mistakes, so there's a bit of a degree of human error. And this poses some questions on the quality of these flags. Then the other thing is, of course, we can do individual assessments. Of course, we normally do it for bigger exposures, and these are the ones that we prioritize in the short term. Eventually, we might be able to do individual assessment of all borrowers which have a restructuring case, but it might not be a cost-efficient thing to do when the amounts are very small. So not always individual assessments can be done. The other problem that we have seen in the field is that there are many institutions that lack flags, or as the case of some of us is that we don't have sufficient flags to really categorize this portfolio. So it's good to know that the portfolio has been restructured, but why it has been restructured and what type of restructuring was performed would be good to know information to be able to then group our portfolio by risk. So how can we do this if we don't have sufficient flags? Well, we can start by creating some flags, and we can do this as easily as grabbing some end of month cuts, let's say something 6 months ago, 3 months ago, and compare what was the situation for that borrower before and now. And from this, we can derive some indicators. In this case, we're giving some examples. So for institutions that don't have a COVID flag, in most of our economies, we know when the government applied COVID relief measures and by which date this has expired, or in some cases this has been renewed a few times. So we can use those dates to classify if the portfolio was COVID or not, if it was restructured. Another way, if we don't have a restructuring flag in our system, is to, for example, compare what was the original installment loan some months ago and what is the current installment that the customer has to pay. Unless it's a regular payment, for example, an agricultural client, if the amount is much lower, then probably this is a restructured case. And due to if the client is facing problems or not of repayment, without visiting individually each one of them, is to see how many of our customers have done a full payment in the last, let's say, 6 months or 3 months. So a client that has been repaying fully is a customer that probably doesn't have any problem. A client that doesn't have any payments is probably a client that is facing a problem. Again, it's an agricultural client, for example. We have then another one, which would be the number of months without any principal payment. And even in some other cases, we can see also if there's some interest payment, because if there's no payment, it's probably a client that has closed down his business for several months and there's no cash inflows. If the customer is paying interest, this at least some kind of the client is not as high risk as somebody that has not been paying in the last 6 months. Another one that we can use is the number of months that the maturity has been extended. So a couple of months of extension of maturity is probably a low risk case. Somebody that has 12 months, 24 months increase of maturity probably is a customer that is facing more serious problems in the business. So what can we do with this information after flagging? Well, we can then categorize the portfolio by a low, medium, high, or high risk portfolio. We can do this by either assigning some kind of criteria. So we can consider a client that has made no payments in the last 6 months as high risk, for example, or we can use a scorecard point system based on the answers. So payments in the last 6 months, 2 or 3 payments, medium risk, let's say 3 points. And if the client has made all payments, we can give a low score, so 0 points, so no risk. Or if there was no payment, then we can apply a higher number to signal high risk. One thing that we recommend is then to do a sample on each one of these groups, so low, medium, or high risk, to confirm your classification or to see if you need to do some readjustment to the categorization you have done, and maybe either the flagging assignment, low, medium, or high risk, or some changes to the point system. After doing this, we of whether our restructured portfolio is low, medium, and high, and then we can even prioritize which customers we should try to do individual assessment from the start. So high risk and then medium would be the strong areas. And with this information, we can also then adjust our ECLs. So if with this, we have of course a change to criteria, no longer the pre-COVID criteria only, but more risk-based criteria with some qualitative information. And with this, then we have more portfolio being assigned stage 1, or low risk, with lower PD, so our ECLs are decreasing. Of course, they are higher than pre-COVID situation, because we know all that there has been businesses that have been medium or highly impacted by COVID, so it's naturally that we have higher number in these stages also. Not to forget that here we always have to consider forward-looking considerations, as IFRS requests for those of us that are implementing IFRS. And also, as we already mentioned in the previous webinar related to IFRS 9 and COVID, we have to make sure that we do an adjustment to LGD, because recovery times have increased, for especially for institutions court proceedings to seize collateral. The courts have been closed, so court cases are taking longer. This has to have some impact in LGT. And now Ardian will start to give you a practical example of a recent assignment that we had with Starbank.
Yeah, thank you, Vanessa. This is actually quite exciting for us, because it's one of the very recent cases that we had, where we basically were expected to make an assessment of the portfolio of this institution and have also an estimation of credit losses. And it very much reflects the reality that we mentioned before, of having to do mass restructuring without being able to assess every single customer individually. And so forth. So is the reason behind why we chose this one to present today. We decided to call it Starbank for anonymity reasons, and also the figures have been anonymized itself. But it is very much the one of the practical cases that we thought would be very useful for you to share the approach that we applied in this case. A couple of words on the institution, just to bring the context. So this was basically an MSME institution focusing on micro customers. The average ticket size was about $2,000 and less. And the reason why the institution was unable to deal with every single customer and be able to assess them individually, so to say, often a lot of those customers being in remote areas where the possibility to get closer to them and to do an individual or customized assessment was not possible. And we had basically to make an overview and assessment of the portfolio, very much depending on the data available, so system related data, and combined with a couple of visits and a sample that we had selected as a means of validating our results, so to say. Before we actually went a lot deep into the numbers, we also made a review of the institution itself and the lending practices and lending methodology, and they were solid before COVID, during COVID. So that was already a good starting point, so to say. And the institution had a very good history of growth in the past, of about 20% growth year on year. So annually, the growth was solid. The portfolio quality was also good pre-COVID. But then they were hit by COVID quite badly. And on top of it, there were also a few natural disasters that were coming one after the other that basically made the situation rather difficult. And the institution had to basically undergo many of those or provide many of those relief measures to their customers after every crisis, after COVID. So relief measures related to COVID. Then after the natural disasters, similar reliefs and so forth, which basically led to the portfolio being quite a bit of a mess, so to say, and with various forms and approaches that had been undertaken on dealing with this portfolio. The PAR indicator was also in the past was very much a proxy of the portfolio quality. We would always use it and have an idea how good or how bad the institution is performing. In this case, it was also difficult to make any use of it because after every crisis, the PAR 30 was going down because many of those relief measures would push defaults down. They would get more breathing space and so forth. So we basically had to use other analytical dimensions to get to the portfolio quality and to be able to assess the portfolio. And this obviously led to quite a divergence between the PAR 30 that was there and the expected losses that we had estimated based on this thorough analysis. And with that, I would pass back to Vanessa to guide us a bit more in detail which concepts we used, how we applied it, and how we came to the calculation and the results that you will see in a minute.
Thank you. So I will start by explaining what were the steps that we took to do this assessment. Well, as already mentioned, we did a pre-COVID assessment. We checked what was the portfolio quality and expected losses before COVID, and we used this as our starting point. As Ardian also mentioned, we did visit clients not only to confirm this assessment that we had done based on the pre-COVID situation, but also to see how these customers have been affected by the COVID and what type of measures had been applied to relieve the situation. Based on this, we came up, as Ardian mentioned, there was some lack of some flags to be able to group the portfolio point system type of classification. So the higher the points, the higher the risk, the lower the points, the lower the risk. Of course, we used days in arrears, but as Ardian already mentioned, days in arrears was not a very good proxy. As we can see here, most of the portfolio was either with no arrears, so almost 70%, and 25% had no payments or was only paying some interest. So due to this reason, we derived some other indicators from the portfolio data. One of those indicators that we did was the number of consecutive months with no payment in the last 6 months. And in this case, we can see that over 25% of the portfolio had no payment at all for 1 or more months. The next indicator that we derived was what was the number of only interest payments in the last 6 months. And in this case, we can see that more than 10% of the portfolio was only interest for 1 or more months. The next indicator that we went and looked at was to the share of disbursed loan versus how much had been paid down by the time that we did the assessment of the portfolio. What we saw was that more than 80% of the portfolio had only paid 25%. And in this case, we have some negative points. If you look closely, if the customer had paid more than 75%, at the time that we did the assessment, we could still very low risk because it's highly likely that the client will, even if they need to find other types of resources to repay the loan, they will find it because it's little amount to be repaid. So this one we gave negative points. And then for the number of extension of maturity, we went and also checked to see how many times as we know in some economies, even this was pushed by the government or the regulator, where they have extended these periods a few times or a couple of times over the time. And our rationale was if the client had more than one maturity extension, this would represent a higher risk than a customer that had maybe none or a couple. We can see here that almost 50% of the portfolio had more than at least one maturity extension. And out of this, around 34% of the portfolio had a monthly extension of more than 12 months, which is a high share. We also looked at the own institutions' assessment of their portfolio, and they had considered that 2% of their portfolio was not recoverable. One thing that we would like to note is this type of scorecard and this type of derived indicators have to be adjusted to each institution because each institution has done restructurings in different ways. Different countries have applied different COVID relief measures, and sometimes even in different sectors. So maybe the microfinance sector has different rules imposed by the regulator than the banks. So we cannot just blindly use this type of scorecard for all institutions. And even in our cases, when we use this type of solution, we adjust it to the institution that we are assessing and the country where the institution is operating. So based on this, we were able then to get a score by each borrower, a cumulative score based on the number of points for each one of these indicators. And based on this, then we did the grouping. So the higher the risk. And we only use this for the portfolio of COVID reliefs. So for this portfolio that had some COVID relief measures, we used this portfolio derived indicators, and we used this scorecard to assign what was the risk profile of the customer. For the portfolio without COVID reliefs, we used the staging criteria pre-COVID that was also in line with what the institution was using. And we used, of course, the historical data from the institution. So, as Arjun already mentioned, we anonymize these values. Sorry. We can see that most of the portfolio, in terms of volume, was in COVID relieved portfolio. But instead of using, for example, restructured criteria as the sole criteria to decide if the loan portfolio was medium or high risk, in this case stage 2 or stage 3, we used this portfolio derived indicators, and with this we were able to assign some portfolio to stage 1. So it was restructured, yes, but we didn't see any significant signs of higher credit risk or that the loan was impaired. And we can see still that stage 3 was a little bit high because there were some cases that we detected of impairments with no payments or only payments of interest. And then we of course had a portfolio which was healthy, which was the portfolio that had no COVID reliefs, and this one was mostly in stage 1. So no problems with arrears. How did we do then to calculate the ECLs? Well, for the portfolio without COVID relief, as we mentioned, we calculated through historical data from the institution, and we use the staging, as already mentioned, based on pre-COVID staging criteria. For the portfolio of COVID relief measures, we use the staging, as already mentioned, with this scorecard, and of course also using days in arrears as a backstop. So if it was 90 days in arrears, then 91 days in arrears, of course, then we would consider it impaired, even if it was not scored high in the other indicators. For PD and LGD, we used as a proxy what was assigned to stage 1, 2, and 3 in the past, because as the institution didn't have a big history on restructured loans from its past, then we could not really calculate historical data for restructured portfolio for stage 1, 2, and 3. And the best proxy is if stage 2 is clients that have significant increase of credit risk, then COVID restructured portfolio that is classified also as medium risk should have a PD that is similar. For stage 3, the same rationale. Again, here, of course, we did some adjustment also. For illustration, we did some adjustment because, of course, times to recover were longer, and this institution had to rely on some court cases to seize collateral. And now Arjun will give a brief summary on what are our key takeaways from doing this type of assessments in estimating credit losses with mass restructurings, and what the institution should do to adjust.
Yeah, actually, before I go in there, I would once again kindly ask you to post any questions that might come along or you might have on your list. Post them as we are coming closer to an end on this webinar, and we will be addressing all of them shortly. So now, yeah, indeed, what are the main takeaways for us? One, which is the basic and the foremost, is that really restructuring is here to stay with us. It might have been a sin in the past, a taboo in many institutions, especially in micro lending, but this has really changed and is going to be with us, is going to stay with us. And the better we organize ourselves, the better we'll be in order to structure the framework, the institution and so forth on how to deal with the restructuring process and how to deal with all this shorter term relief that risk time were related to COVID in future might be related to different natural disasters or any other reasons that might political, economical and other type of crisis that the countries and institutions might face. So the earlier we organize ourselves, the better it is. In that sense, what I mean with organization is that institutions should have in place a proper framework, a methodology on how to or criteria on how to categorize different customers, as we outlined before, on who to take responsibility for which part of customers, what are the key processes, approvals, and so forth. So to have that in place, and also to have a proper system or proper flagging possibility in your system so you can track and you can monitor these loans. What this would obviously lead to is that, first of all, you would have the possibility to differentiate your customers, which are the good customers from the bad customers. And when I mean good and bad, not referring to them on personal capacity, but really which are the performing customers and which are the customers that need different treatment, and how to give them the best treatment forward so they can get back on their feet. So that would be very useful for the clients themselves, but also for the institution, because this way you would be able to classify or categorize these customers in what we saw before in the 3 categories: low, medium risk, or you can have even more if you have more criteria that would be more applicable in your institution. But this way you would have the minimum 3 categories. You would be able to say which is my performing portfolio in that big pot of restructured, which are performing, which are underperforming, which are non-performing, and you would also then be able to adequately treat each one of them with different measures in place and different approach on providing them the treatment basically that they would need. And this way it would lead to an increase on the recovery for the institution, increase in oversight, and would be rather effective because institutions would know how to deal with these customers and how to manage them. That being said, once you have the stage, and then you would also be able to know how much provision you should set aside, what are the loss estimates that you have in those portfolios, in those different categories, and be able to make an estimate on what is the loss forward and be able to build an adequate provisions. And last but not least, this would also lead to an improvement on the reporting transparency, which, as I mentioned at the beginning, right now is a concern for lenders, auditors, regulators, and everybody, shareholders and so forth, who don't really have a full oversight on the institution. So once having this in place would increase the transparency and would really make the figures that you would present more credible, as currently, if they are challenged, say if you put your restructuring into performing or the pot, people would realize that is an overestimation of your performance. If you put all of them as loss, you cannot afford, because your PAR 30 would reach at high levels, and your expected losses would be substantial, so you would not be able to afford it. But once you have this classification, then you would be able to present these figures, and you would be able to also convincingly show them on all parties as something that is reflecting the reality of your situation. With this said, we have come to an end with the content that we wanted to cover in this session. I would like to open the floor now for questions and answers. So please, once again, feel free to post any questions you might have in the Q&A button at the bottom of this page, and I would invite Carmen to take now the lead and support us in this process.
Thank you very much, Vanessa. Thank you, Adrian. Thank you to our translators in French who have been working in the background. And we indeed have a few questions that have come in already, but the first one that has come in is, I think, a fairly quick clarification between the difference between refinancing and restructuring. How similar or how different are they in these two terms you use?
Yeah, thank you, Carmen. That's actually a very, very interesting question. I mean, typically in the corporate banking, a refinanced loan would be a loan that is granted to a customer who not necessarily is in trouble. So you give them a new loan, conditions might have changed, so you give them a new financing, and hence it's called refinancing. However, what we see in practice, especially in microfinance institutions, this almost always is connected to the type of restructuring. So when the client is in some kind of trouble, in some kind of area, then this is classified as refinanced. And often the refinance by regulators and auditors is also considered then as a restructured loan. And what we also see actually in practice is that, especially recently after COVID, that so many different naming has come forward when it comes to restructuring, like reprogramming, renegotiation, renovation, and all the re's that kind of reflect, they don't want to call it restructuring because of that bad connotation that I mentioned earlier. So all the other names are kicking in, like rescheduled and reprogrammed and so forth. And refinancing does play a role and is one of those elements. Typically, if it is related to providing a breathing space to the customer and changing the payment plan or rescheduling the plan of the customer in order to give them more space, I would consider those as restructured. If it is really a new loan that you grant to the customer because the conditions in the market have changed, for example, interest rates are lower and so forth, or the client needs a bigger loan and he wants to cancel the loan that he currently had, and in that case, a refinancing would be kind of a new facility, would not be considered as part of any kind of restructuring. But again, that very much depends on the maturity of the institution. As I mentioned, corporate banks do that often and then manage it better. Smaller institutions, they relate somewhat with the restructuring process.
Thank you. Then we go to the next question, and I'll read it to you from here. How do you consider the movement of profitability of default, PDs? As of now, the situation of loan quality changes substantially in just these few months. This will affect the PD trend that we consider up to 24 months.
What we typically do in these situations is, but for this we need to know when the COVID relief measures were applied and when they were stopped to be applied. So this period we have seen in most cases a freeze of the portfolio. So, as Ardian mentioned, not only a freeze, but that portfolio that maybe before was par above 90 or above 30 has returned to a status of zero arrears. So in this case, we normally exclude this months from the historical data and use the historical data before the COVID measures were applied. And if they have already phased out, in some economies this is not the case, in some economies this has already happened for at least 3-4 months, then you already can see from this portfolio that was no arrears in a more artificial way how it has migrated in terms of days in arrears, or maybe again another restructuring was granted, maybe with a higher extension of maturity. So yes, PD has to be a little bit adjusted, but we see it more as ignoring this freeze period of COVID relief measures.
Thank you. And then how do you link the PAR projection? Sorry, how do you link the PAR projection with restructuring loan amount?
So if I understand correctly, you want to know how to project, for example, what will be my development of, for example, PAR above 30 with restructured. Well, this restructured here is a little bit of a qualitative criteria, as we mentioned. So here it would be more, I think, projection of what would be the development of my medium risk portfolio, which would be my stage 2 portfolio. So this includes a portfolio that is in PAR above 30 days, for example, and portfolio that we consider to be medium risk restructured. The same thing for PAR that is above 90 days and restructuring where we think that there is a higher likelihood of losing a significant amount of the portfolio because the client will not be able to repay fully.
But we understand that it is challenging to do projection under the circumstances. And when you do restructuring, basically you change the payment plan. If you do that without really having an individual assessment of the customer, it becomes challenging. But what you can still do if you use some of these criteria to cluster the customer. If it is in low risk, then you would obviously have a much higher expectation that they would perform. If you really consider them as high risk, and if you are not able to do individualized assessment, you can use some of these analytical dimensions that we mentioned. One, for example, if the loan has paid more than 75% of the amount, if that would be the case, I would typically consider it as low risk and would not include it in my PAR projection. But if not, then perhaps I would include in the PAR projection. And depending on other criteria as well, other dimensions that we mentioned, we included there. It can help you and guide you into how to include some of those in your projections.
Mm-hmm. Thank you. And then I think in the similar direction is should interest accrued from loan restructuring be added up on the loan outstanding after the end of loan restructuring?
I mean, this actually can be done differently. It very much depends on the environment and how regulators allow. In some countries, the adding up of the accruals is not permitted, so you cannot capitalize interest, and that basically comes as a regulation from the central bank. In some others, it is possible. Whenever it is possible, I think either capitalizing it in the restructuring process or adding it as additional months at the end should be feasible, should be possible. However, one should always also consider, with all these accruals on top, and we are talking of micro clients, the capacity that they have to repay is not all too big. If they've been in lockdown for a couple of months and so forth, they might have consumed big parts of their working capital. And by just adding that, you're not going to solve the situation. You might actually counter-incentivize them to even pay. So in some circumstances, you might also have to think on how to perhaps give for all this accrued interest amount to have it interest-free, for example, that you don't charge interest on interest, or even perhaps forego part of it if you can absorb as a means of increasing recoverability, especially for the clients that are more vulnerable and so forth. So just keep that in mind, that by just adding at the end of the maturity or capitalizing, you don't necessarily increase the chance of recovering that loan amount. So it has to be a bit considered more on customer capacity. What can they handle? What can they afford, without coming to a point that you disincentivize them to pay the loan.
Thank you. Then we come to the next one. It's a slightly longer one, so I'll read it to you. Restructuring has hit the companies very badly when it comes to ECL. Certain regulators have given some relaxation, but as part of a global company, we have to be 100% in compliance with IFRS 9. This increased the impairment overall. Is there any discussion in your knowledge that IASB may relax some IFRS 9 for staging due to restructuring?
As we mentioned, the IFRS did mention that you shouldn't apply pre-COVID criteria as before. So we know pre-COVID criteria before was restructured loans are stage 2. After a few months of good evidence of repayment, that could migrate to stage 1. If you are restructuring several times the same borrower, then you have less arguments to say that it's not stage 3. However, this was pre-COVID. When COVID hit, many of the measures that were applied resembled like restructured. So IFRS did mention, please do not mechanically apply these criteria. Now, what has happened is, as Ardin mentioned, if you are not able to say from your restructured portfolio what is low risk, what is medium risk, and what is high risk, from the point of view of regulators and auditors, they really don't know what is the quality of your restructured portfolio. And here I mean the restructured portfolio due to COVID. So if you're not able to say what is low risk, which if they don't know, then naturally the tendency will be that you should consider it as high, significant.
I think we have some connection issues.
This is why we are proposing that you use derived portfolio criteria if you cannot individually assess all the portfolio in a short term, to classify and group your portfolio with criteria that you can show and you can explain and you can show evidence that portfolio with this criteria is showing over time that it's low risk. Portfolio with this type of criteria is showing evidence that it is impaired. So for this portfolio that is low risk, I consider it stage 1, not stage 2 or 3.
And perhaps just to re-emphasize that there might be changes coming up. We don't really know that they've been acting a bit slow, not because they want to, but it's just a complex situation. So the likelihood that this will be resolved anytime soon is not all too high in my view. Thereby, our recommendation is really that you take the fate on your own hands, because this is what you can do. And once you have this in place, I think it is easier to convince also auditors and everybody on the methodology you apply and how you move forward. if anything comes, then it just facilitates the process because you have a framework in place and you would be able to quickly adopt it. And please note that whenever these changes happen, there are different audit firms and different application that takes place from them. So it also gets by expecting them to resolve and then acting upon it, it gets a bit late and it becomes a bit cumbersome and difficult on your end. So the better you organize, or the sooner you organize, you basically take control of it, and then whatever comes might help, and you would be easier adapting to all these changes that might be coming across from the IASB or whoever would be issuing such guidance. In some instances, the regulators are taking more of an active role. We would also expect perhaps the regulators to be more forward in this, but again, very difficult to say, really.
Right. Thank you for very exhaustively answering this one. Let's move to, I'll just take them in order as they come. So could a transition matrix be used to estimate PDs during the COVID period?
This brings us a little bit back to the answer to the first question, or the second one. This is where we would recommend not using matrices. So if you use a transition matrix in this period, if the COVID relief measures was that the portfolio returns to a status of no arrears, then if you're using par buckets as your criteria for transition matrices, then naturally all of your portfolio would look like it recovered. Which would not be realistic, because from some of this portfolio that has been restructured due to COVID, naturally, after the COVID relief measures have phased out, will return to a status of above par 30 or a situation of default. So this period, as it's an artificial freeze, we recommend not including in the transition matrices. So you would exclude this period and then continue, and not immediately after the COVID measures have been phased out, but I would say at least 3 months afterwards, because this already gives you time to see, in terms of days in arrears, which customers are paying and which ones are not.
Jan, something to add? Or
no, I absolutely disagree.
Cool. Mm-hmm. Then here's the next one is, Adrian mentioned that pre-COVID restructuring was used as a loss recovery measure, but now has a wider application. This seems to apply to unsecured loans and not those with adequate collateral, where loss recovery is usually enforcement of collateral. Is that correct?
Mm-hmm. I mean, in principle, we are talking of the restructuring for both collateralized and uncollateralized portfolio. I think majority of institutions here were mostly on micro that are under collateralized or uncollateralized, but even the ones that have collateral are proposal and of the way of doing business has always been, even those really restructuring and trying to be able to find a workout with these customers. Obviously, collateral always gives you an edge, so you have more pressure on the customers, more possibility to go via other means. But what we also see is that execution of collaterals is always difficult, partially because it takes a lot of time to legally manage it, but also often there is just no demand for some of those, or the process takes really long for you to be able to get back your principal or cash. So what we see with restructuring in cases that they have collateral is that whenever they take this measure on their own hand, they're not able to sell some of those assets from the customers themselves. It always speeds up the process. And if you have that as a pressure mechanism, I would say in cases that merits to have this pressure exercised, then I'd rather ask the client to execute it, to sell it, and use some of these proceeds to pay, thereby providing them a restructuring instead of going through the legal means and litigation and so forth, which in my view, or partially because I'm a banker, not a lawyer, and I stay as much away as I can from lawyers. So it just kind of increases the recoverability when you apply this approach. But again, what we were speaking mostly here is how to deal with customers that really are are willing to cooperate with you or working with you. And in most of those cases, collateral plays less role, where collateral, in my view, plays really a significant role, or with the customers that are becoming difficult, and you use it as a point of pressure and exercise them. But in the other cases, I would just try to basically get an agreement, have a restructuring in place, and ask or push the client to make execution of those sale of those assets, and be able to get the proceeds and partially channeled to the institution as loss recovery.
Thank you. And we have a few more, and we have plenty of time also left. So if you have a few more questions to any of our participants, please add them. We have a few more to go, and we have a little more time also for a few more. For the client who was provided more than one time with a restructuring, could we consider them in stage 2? I think it's stage rather than state.
Mm-hmm.
Yes, this, as I said, was typical criteria pre-COVID, and it was a lot of it being pushed by regulators and auditors. With COVID restructure portfolio, what we have seen in some economies is that there has been a wave of restructuring which didn't happen only once, but a few times. So in the early onset of the pandemic, many economies granted a couple of months, maybe a quarter, of extension of maturity, hoping that it was like a flu, so it would pass as all flus. The situation didn't happen like this, so many economies had to renew the COVID relief measures, and even have reinstated some with the waves. In some countries, we are already in the 4th wave of COVID. So this would mean that you will easily, just due to COVID, fall into this category of 2 times, 3 times, 4 times restructuring. So during COVID times, I think you should not apply this mechanical criteria. Before COVID, then again, it is a lot to do with your history. Why would you restructure a client twice and you would not consider it impaired? What happened for the first restructure not to go well? So it is a lot of this qualitative criteria which was lacking in the past, because restructure portfolio was not that much, to be honest, in our portfolios. So why should we have more complex criteria to determine if it was a client that had some temporary problem but would likely pay us, or a client that with a lot of effort and with a lot of probability of not paying, we might have to waive some principal or write off some principal interest. So in the end, it has to do with the qualitative criteria. If you just use as criterion number of restructurings before COVID, it's difficult to argue. After COVID, I think it's more easy to argue if these measures were a lot imposed by regulators. I don't know if you want to add something, Arjun.
No, basically in the same line, that don't apply it mechanically. Look a bit beyond in these portfolios. Traditionally, yes, it would go into stage 2 under the circumstances. Perhaps not, because you had the first wave, you had the second wave. In some countries, actually, the regulator itself was just granting a month of relief, so institutions had to do every month a new relief and a new relief. So in those cases, big part of portfolio that would flow into stage 2, and that would be first penalizing your client, but also for the institution would become quite heavy. So you have to basically look a bit deeper who are behind those cases, like use some of those analytical components to be able to understand the likelihood of these customers repaying or not as a means of reclassification, but not mechanically just putting it on the stage 2.
Mm-hmm.
Just one thing, Arjun, in some economies actually at stage 3. But then it is to do with a lot with your arguments. So if you can show through statistics that even for the loans that are restructured twice, the risk is medium, not high, then there's no reason for you to put it in impairment. But you have to provide statistical evidence of this to your auditors and regulators.
And you actually have to fix a bit the whole process and the framework, because if you just put everything in stage one, obviously nobody's going to accept that. If you whenever you use this a bit more extreme way of classifying, it raises alerts. So if it's stage one, everybody would feel concerned because they would know that that's not the reality. If you put them stage two, stage three becomes too heavy. But once you have a framework in place and once you are able to explain why and how you're coming to these conclusions, I think it gets easier for also auditors, regulators, and so forth to accept that, because otherwise it just becomes your view against their view, and often leads to no solution, so to say.
Thank you. Then to the next question. Is it legal to provide, I'll just read it. Is it legally that provide restructured loan, which has already in an area more than 30 days of MFI or MDI?
If I understand correctly, the question would be, is it legal to provide a restructuring to a loan that has been more than 30 days in arrears? Typically, yes. I mean, you do provide restructuring also to loans that are in arrears. You can also provide restructuring to loans that are not in arrears, and you would have to understand the reasons why you're doing that restructuring, and thereby then be able to classify, is it low, medium, or high risk? Is it really you're doing a restructuring because the situation of the customer is very difficult and you need to do a long-term restructuring and you need to give waivers and so forth to get it through, in which case you would consider as high risk. If it is something that is less permanent, something of temporary nature, you might give them a restructuring without necessarily classifying it in a medium or high risk, thereby consider it as normal portfolio and so forth. Once it goes above 30 days, it becomes difficult to argue that this loan is still performing loan because it has been 30 days in arrears. If that was because you were unable to treat it during COVID, because your system was not in place or you were in lockdown and so forth, perhaps you can argue. But technically or typically, a loan that would be in default for more than 30 days and you restructure, you have less chance of classifying it as performing or as low risk portfolio, so to say. So, sorry, go ahead, Martha.
Yeah, just to mention something, I know that in some economies, especially in MFIs, some of the regulators do put in the regulation that you're forbidden to restructure a loan after 30 days in arrears. But in this case, I think, especially now due to COVID, you can negotiate with the regulator and discuss, because your situation is the same as many other MFIs in your sector who are struggling with this very strict rule, which was okay when you were doing very few restructurings, but now as you're doing mass restructurings, and as I already mentioned, maybe you were at the lockdown, you were not able to physically do the restructuring, or other types of reasons that might explain why there was a delay and you were not able to restructure before 30 days, then I think you have enough arguments to sit down with the regulator and open some exceptions for this period.
Thank you for this one as well. And we go to the next one. Should the current restructuring be done, keeping in mind that a third wave of COVID might come? How will banks perceive it, because it is not feasible to restructure borrowers' loan more than once?
I mean, that again, I think would very much depend on what's really the likelihood of a third wave coming. If you really see that in the horizon and you realize that the customer would not be able to keep up with the payment as it is, then I would consider it, would give a bit more breathing space, and would perhaps make a longer restructuring, just to avoid that months later you are again at the same starting point, because it's also a lot of burden operationally to do all this restructuring. So I would perhaps consider it. But if it's not all too much in the horizon and we see many economies starting to recover, vaccination moving up, so a third wave might actually not come in many of these countries, then just because of the risk that there might be a third wave at some point, I would not necessarily go and restructure with that in mind. So I would then try to make it a bit more realistic on the customer circumstances, on the context where you are, and try to restructure it for that period without doing it lengthier and assuming a third wave coming along, so to say. And as mentioned, I mean, in many of these environments, this one-time restructuring has somewhat been lifted, because I used to work in an environment where you had one restructuring and the second basically would be not forbidden, not allowed unless the board would approve, and then would automatically invoke significant provisions. All of those were lifted during COVID, because everybody realized that a first wave coming, and this first wave initially was with a lockdown of 3 weeks, and then went another 3 weeks, and went another 3 months. So everybody realized that it is difficult to just keep up with that rule, and some of those were lifted, some of those were made more or were relaxed. And I would also expect that in those circumstances, regulators will move and will support institutions, as obviously they also have no interest on pushing institutions into difficulty and default. So you would expect to have some kind of positive response on their end as well.
Thank you. And here we have, for now, as our last question, is there any standard criteria to categorize clients in any stage of the risk?
Vanessa, do you want to?
Yeah. For this one, I would say so. If we look at IFRS 9, they use days in arrears as backstop. If you want to argue that your stage 2 loans only start after 60 days in arrears, then you have to provide some argument and evidence on why this makes sense for your institution. So even though it's not fixed, so it's used as a backstop. If you don't have any strong arguments, you have to use it as a backstop. But again, the other type of criteria is a lot of it qualitative. And it was a push from the regulators and the auditors to use restructured status, because the IFRS 9 talks about restructuring, but more in accounting terms and what happens in accounting terms, but not so much as a clear-cut criteria that is in the IFRS 9 standards. They rather talk about, and again, it's examples that they provide, criteria which is quantitative to determine if there is a significant increase of credit risk, or if there's impairment of the borrower. Restructuring is part of this, but it has more to do with, is the client capable of repaying the loan? Is it the client facing a temporary problem or not? So the criteria has to be not only something so hard as days in arrears, but also other qualitative information. And if you restrict yourself to what is common in industry, so restructuring status, you end up with the situation that we ended up with COVID, which is if you apply mechanically these straightforward indicators and criteria, then you have trouble with your loan loss provisions, because you're likely going to over provision, and you probably cannot afford to over provision. So our recommendation is really to use qualitative criteria, and ideally
better connection.
Vanessa, you just dropped after you said ideally.
Ideally after what? I think I mentioned it twice, so.
Oh.
Ideally probably was the last bit, which was with ideally you should have these indicators in your core banking system, because otherwise it's very difficult to track. And then it's too much effort also to do it. But at the moment, I think the effort is worthwhile, because if you use such simplistic criteria as days in arrears and only if the loan is restructured or not, then you're likely going to over provision, and you cannot afford to over provision.
Okay. So, thank you. This is the last question we have here. We've had a wonderful message saying thank you and appreciating. We also, from our part, Thank you for your questions. Thank you for your attention. Thank you for our presenters for your presentations and all your answers. This is still extraordinary times, and we're all finding our way through it with the help we can get and the way we can work with it. What helps us very much for topics in terms of what is relevant to you, so we can make it really interesting to you and bring you what we see from others, what we experience also. Please take a few minutes that when you leave, there's a survey that comes up and there's a few questions around the topics that might be of interest to you that are really relevant to you right now. Because even though we're former managers of microfinance institutions at Inspiring Development, us in Triple Jump, it is much more helpful when you know exactly, because, apologies, because you know exactly what you need. So do let us know by this survey is a really good means. So thank you for that. And also the recording will be available together with the PowerPoint. We'll have it through to you by the email from Zoom within the next 48 hours. It always takes a little time. And the thank you I forgot, I just realized, is of course to Triple Jump Advisory Services for making this sort of event possible, giving us the space, inviting you, working with all of us to see what new insights we can share and what we can come up with. So here it remains for me to wish you a wonderful day and stay well.
Thank you.
Thank you.
Thank you. Have a very nice day.